Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company LifeChamp. Today, we are very excited to be doing this topic, which is the intelligent investors mindset. Good to see all of you here. This is our first English webinar in the year of 2023. So welcome all of you back to this series. My name is Shen Chu. I'm the moderator for this session. Now, investing requires more than just financial knowledge and also analytical skills. It also requires you to have a good mindset. And today, we're going to talk about what is the intelligent investor mindset and how we can map this mental building block and position ourselves for success in the investing world. So allow me to briefly share with you the disclaimer before we begin. Whatever presented in this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. Now, allow me to briefly introduce our speaker, and he is none other than the co-founder and managing director of Spiral Thinker Group, which is Mr. David Poh.
Hi, good
David
evening.
is also... Yes, David, welcome to this session. Now, allow me to briefly introduce David. Now, he's a thinker, wealth creator, and value seeker. Wow, I love it. And he's an engineer by training. He's also a full-time private investor, a portfolio consultant, and he dedicates his life to advocate intelligent value investing. And he believes in long-term wealth creation with equities. Today, he's going to present to us, how do we adopt an intelligent investor mindset. So good to see you here, David. How are you?
Hi, Shane. Good evening to you. It's good to be back after such a long break. Hope you have a good break to last year and as well as the beginning of this year.
Yeah, I did. Yep.
Right.
So I'll hand over the session to you.
All right. Thanks. First of all, again, thanks to Shane and LifeChamp for inviting us once again to come back and share with your distinguished guests online about how we look at and how we go about with our investing. Now, tonight's topic is very interesting in my own personal opinion. It's called the intelligent investors mindset. So as usual, normally what I would do is I'll break out my session to a couple of subtopics. So tonight there'll be 4 subtopics. We're going to start off with the concept of intelligence. Bear in mind that tonight's session is very conceptual. So there's not a lot of technical stuff that I'm going to go through, but more of a mindset or kind of conceptual a point of view of how we approach investing. Yeah. Of course, to hammer down the gist of what makes up an intelligent mindset, I will bring in the fundamental difference between price and value to really conceptualize what is intelligence, as well as the need for margin of safety. Then last but not least, as usual, I'm going to end with the case study, a very practical case study, which is just happened to me and my team recently on the oxymoron of prediction. Right. So hopefully you guys stay with me away until the end of this session. I've talked to Shane. I said that I'll try to allocate more time for Q&A session later on. So make sure that you stay with us all the way to the end. Yeah. Right. Let me just do this first. Annotation spotlight. Yeah, great. Before we begin, maybe just a recap of what are the previous topics related to the investor's mindset or the psychology, which I have delivered in this Bursa Malaysia's webinars. Now, I realized that actually I have not done a lot. In fact, most of my sessions before was surrounding the, how to read financial statements, what is fundamental analysis, what is value investing, to even portfolio management, right? So I think in the last couple of years, I did allocate quite a lot of sessions on set topics related to how to manage your portfolios as your own fund manager. And I realized that actually those things are important, but they are not the entire story. In fact, in my personal opinion, they make at most half of the story. The other half of the story, of your story, of our journey in order to become a successful investor really depends on the psychology aspects. Yeah. And that is why I've talked to Shane and said, moving forward, I would like to focus more on this kind of topic because they are as important, if not more important, to determine, the success of an investment journey. So I think back in the only topic that I've talked about related to the investor psychology was back in 2022, just a few months ago, back in May, whereby the topic was entitled Investor Psychology to Thrive in Any Market. Now, to recall, I think some of the main topics or the main key takeaways that I delivered that night was regarding what's fear and greed versus logic. These are the emotions and the factors that are driving the market, as well as to differentiate between the different mindsets of traders versus investors. Then I bring in a lot of interesting characters like the assassins, the hunter, the rabbits versus the raiders and connoisseurs. Now, if you recall, for those who have joined me in this session, what we aim to be, which character we aim to emulate to be successful in the investing in the market is really to be a connoisseur, right? If you don't know what I'm talking about, please go back to the archive in LifeChamp's YouTube channel to look for this topic. Yeah, but I would like to maybe just remind our guests tonight that to be successful in investing is really just a function of the micro, the macro, and external factors plus the psychology, well-being, and the mindset of the investor, and that is what I would like to focus on tonight. And before I go on, again, I would like to, sometimes most of the time I like to quote, these very successful investors like Warren Buffett. And tonight I would like to quote something from Benjamin Graham. He said that investment is the most intelligent when it is most business-like. Now, I've talked about this many times in my previous sessions, whereby I focus more on the business-like factor. So tonight, for this session, I will be talking more on the intelligent aspect. What makes an intelligent mindset? What makes an intelligent investor? All right. Now, maybe I'd just like to highlight here tonight, before I go on that, whatever I shared is predominantly what I've encountered, what me and my team has learned in our years of investments. And you may not necessarily get this from any literature or any books that you read. If you ask me, actually, it's a combination of what we read, what we gather, as well as our experience, which I'll explain later on in this session. Yeah. So let's start off with the concept of intelligence. Like I said just now, this topic is really a lot about conceptualization, and this is a very important aspect that we need to, at least master to be successful in investing. Now, again, normally when I talk about the definitions, right, I normally like to start with what it is not. So what intelligence is? Before I talk about that, I would like to talk about what intelligence is not. Yeah. Now, intelligent is not any of these words that appear on the screen. It is not listening to rumors. It's not listening or following hearsay. It is not something that you do impulsively. It's not it's not irrational actions. It's not unfounded guesswork. And intelligent, most of all, doesn't mean complexity. Now, I know a lot of people or investors or traders that I've encountered, right? They really like to present very complex model, whether it's wave counts or the way they look at the quantitative analysis of a business, right? I mean, those can help you, but sometimes when it is too complex, it is very hard to understand, and you may miss the big picture when you focus too much on the small details. Now, in my own personal experience along the way, when I started out, I used to be very detailed. I remember that sometimes a business model that I created for a particular company or a stock has as many as 10 or 12 tabs in Excel sheet, which I later on realized that I don't really look at all of them, and not all of them are important. And when I started my journey as a market participant, participation many years ago. I started with trading. I started looking at technical analysis first before I ventured into value investing. I remember I had more than, I guess, 15, 16 indicators in my technical chart, and it became too complex that I didn't know what I was looking at. So coming back to the point here, complexity doesn't necessarily mean intelligent, right? So remember, all these things usually, which is associated to emotional, aspects of investing. These are usually not what intelligence is. So what is intelligent then? Now, the good news here is actually the intelligent mindset can be trained. All right. Of course, I did not start off as having an intelligent investor mindset from day one. In fact, I was a speculator from day one, right? Like everyone here, or almost everyone here, I would say. So it takes years and years of mistakes, learning curve, very steep learning curve, and most of all, a lot of perseverance. Now, I think this is perseverance is something which is really underrated in investing circle, but it is one of the most important criteria that anyone must have to really make it big in the investment journey, right? So how do I conceptualize in an intelligent mindset? So basically, I divided to two parts: the scientific part as well as the empirical part. Now, empirical, in layman's terms, just means something that is experimental, that you have to rely on data, data sets for you to prove something, right? Now, on the scientific part, and I think this is something that a lot of us have to do, if you really want to be a serious investor, is you have to read a lot of things. Now, Charlie Munger advocates reading as one of the most important things everyone must do in order to be successful in investing, right? So in this regard, right, the scientific approach to training your mindset to be intelligent in investing is really to do a lot of study, a lot of research, and analyzing a lot of data which are related to your investment. It could be fundamental data, your financial analysis. It could be technical analysis. I don't know if that is your or your approach, right? It's not wrong, but you have to have a systematic and scientific way of doing this. Now, when I say this, I don't mean just reading for the fun of it or reading without really processing the information. You have to go through different layers of information processing, first, second, third layer of information processing, in order for you to form a mental model of what you are reading about, right? So this is the scientific portion. Now, the empirical portion is where you really have to put things into practice. Now, there's no point reading too much and not really putting your what you learn into action, because putting things into action will really strengthen your conviction whether a specific strategy works or does not work, right? So this is very important. So inherently, and inevitably, each and every one of us, when we started out, or even after we started out a few years, right, we have to go through a lot of trial and errors. We will definitely make a lot of mistakes. I am still making mistakes even today. It takes a lot of conditioning of your mindset. And last but not least, your personality also plays a huge role, in training your mindset. Now, because of my personality, I find that I learn a lot. I learn more from my errors compared to my successes. But to you, reader, the listener out there, you may learn more, or you may react more to successes more than your mistakes. So each and every one of us are wired differently in our mind. So you have to understand what your personality is. Some people, after a couple of failures, they say, okay, F it, I give up. But for me, I'm a born in a year of horse. I'm very stubborn in nature. The more the market tells me I'm wrong, or the more other people tells me I can't make it, I will even work harder, double down on my efforts to make it work. And last but not least, EQ plays an important role. Now, the scientific part of this exercise is really more related to your cognitive intelligence, whereas the empirical part really involves more of your emotional intelligence, right? So when you put this together and mix it jumble and you practice this, right, you have to apply what you've learned as well as what you have, what you learn from the scientific approach as well from the empirical approach, and combine together so that you can learn along the way as well. Now, doesn't mean that, okay, now I studied this company from A to Z. I went through all the financial analysis, the quantitative and the qualitative analysis. I've gone through different types of, I've gone through various paper trades, for example, but you don't really apply in real life, it won't matter as well, because only when you do it with real money, real emotions involved, that's where you really learn, right? Now, just knowing doesn't, and without applying, won't give rise to an intelligent mindset. You have to put it into practice. Now, along the way, of course, because you make mistakes, right? You accumulate a lot of experience. And the most important thing here is that once you accumulate your experience, you learn from mistakes. You have to go back to your mental model, to your model, to look at what went wrong or what you could have done better, and try to refine your process. All right. And if you do this repeatedly, I guarantee you, right, you'll be a more learned, you'll be more experienced, you'll be more intelligent without you realizing it. All right. And you don't count the beans along the way. It won't happen. The more you try to pursue, I want to have an intelligent mindset, it won't happen. It will come to you naturally as you go along. And the most important thing is you persevere. Now, as long as you do this day in, day out, right, across different market cycles, as you have to experience different market cycles, this is where wisdom will come about. Now, having wisdom is having the quality of being intelligent. You know how to apply the knowledge. You know how to sense. You can be more sensible, to things as related to investment. You know how to value a business. You know how to size up a management, in a very short period of time, compared to one who does not go through this process, right? So this is a very important exercise you have to go through. Some people who are fast learners, they may acquire this skill sets or experience in a very short time of period, maybe a couple of years. But for people like myself who learn more from mistakes, right? It took me many, many years for me to really come to the point where I think that I'm experienced enough, to, as well having to have the intelligent mental model to really be successful in investing. Even today, I would say most of my mistakes will come from the emotional side rather than the scientific side. Now, I mean, when it comes to the logical side, it's very easy, 1 + 1. You just need to really be good at arithmetics, not even algebra, right? And you've got to have a really logical mindset. But when it comes to price, the price fluctuation, that is when the human in us, I talk about the brain structure in my previous session, right? This is where the animal side of the brain will kick out, the fear, the greed, right? And even up to today, and I suspect in many years to come, I would still be very much susceptible to this kind of human nature, right? So that is why we need to do this over and over again, and hopefully over time we accrue more experience, all right? And we should eventually translate to a higher wisdom when it comes to approaching the stock market. Right. So I'm with you. I'm not there yet. I have to say very honestly, I'm still learning my trade. So hopefully we learn together. All right. So after that, after the conceptualization of what makes an intelligent mindset, let's move on to talk a little bit more about what is the distinctive differences between price and value. Because without knowing this, then we don't know how to anchor, the intelligence mindset to some. We got to anchor that to something, right? So I think price is one of the most interesting and most impactful element in investing that will truly challenge the investor, especially when it comes to the mindset. Now, in my opinion, price is essentially just a function of the underlying fundamentals as well as market expectation. Now, I think I've talked about this in my previous webinar before. It could be price of anything. It could be price of a product. It could be price of a service. It could be a price of a concert ticket, right? When there's a lot of demand, when people are crazy about this particular artist or celebrity, right? The underlying, the fundamentals are there, all right? It will drive up the supply. It will really drive up the skew, the supply demand balance of the price, right? Then of course there's market expectation as well. Now I've come to realize that in the long term, the underlying fundamentals matter the most, but in the short term, actually market expectations play the more pivotal role in determining the price movement. So of course, we can't just talk about price alone. We need to compare price with definitely the value, because when it comes to investment, it's usually price and value, right? So you know what they say, right? Price is what you pay, value is what you get. I think that's a very layman's term of differentiating the two, but I have a different approach, a more systematic comparison between the two. So I'm going to kick off saying that price is really more monetary in nature. So you've got to have a figure attached to price, whether it's in dollars or cents, right? There's always a price to pay. Now, the value that you get after you pay the price is more intrinsic in nature. Now, the word intrinsic means something which is inherent, naturally belonging to something. So I know a lot of, especially in the school of value investing, a lot of people talk about intrinsic value. What is the intrinsic value of a stock? What is the intrinsic value of a business? All right. Now, in my opinion, it is important, it is essential to understand or to guesstimate the intrinsic value of a business, but it is not necessarily a scientific process. So I talk about the scientific as well as empirical process of intelligent mindset, right? So value is something which is more intrinsic rather than extrinsic, which is price, okay? Price is an important factor which is used to transfer a perceived value. Let's say I think that this product should be valued at a certain price, and in order for me to transfer the asset to the buyer has to pay me that certain price. So price is a transactional value there. Now on the other hand, value is more of a measure of utility or worth. Because after I buy the thing, how the thing will give me enjoyment or utility really depends on personal experience. And that, of course, apply to stock as well. Price is the instantaneous cost you pay to acquire an asset or a business, or something that you will receive, all right, when you sell off a particular asset or business. Whereas on the other hand, value is really the accrued compensation, meaning something that a value that will be accrued sometime in the future, assuming this business or this value will increase, this asset will increase in value over time. All right, and price is something that you have to pay today. Now, price is very volatile. It's really subject to supply and demand. And also, in other words, it's also very susceptible to sentiment. When the sentiment is good, it's very positive. It's in a very euphoric sentiment, right? Then the market tends to drive up the price. On the other hand, the value is derived more from a deterministic manner. So there is perhaps a more scientific way to go to determine, okay, what is the inherent value of this particular business at this point of time, considering the macro or the interest rates, for example, at this point of time. So that's how you derive a value of this company, right? There are still assumptions to be made there. Now, after acquiring a particular asset, security, or business, the value of the business or the asset may undergo some sort of accretion over time, which means it increases in value so that you can sell it at a higher price in the future, or it may also erode in time, especially businesses that are not well run, right? So I think a very recent and a very interesting case study would be, recently, 2 years ago, the value of glove stocks really increases exponentially because of, the market perceived the intrinsic value to skyrocket as well due to the exponential demand for the glove products due to the pandemic, right? But then when the market over expects or the market expectations were too high or too unrealistic, then when the reality sets in, that's where there will be a lot of erosion of the value from the high point. All right, so these are fundamentally the difference between price and value. You know this difference because it will really affect your mindset when it comes to investment. If you focus too much on the price, day in, day out, then we may really lose sight of what are the kind of value that we acquire when we invest in a certain security or a certain stock. All right, I hope that you have this in mind. So again, when you talk about price and value, there's always a short term and a long term. Now, people say, and this is again something which is coined by Benjamin Graham. He said that in the short term, the market, investing is really like a voting machine, right? And in the longer term, it's really more like a weighing machine. Now, I think I stressed before that this is something very simple. It's a very simple concept, but it's very profound, right? You see, voting machine is really, when people go to vote, do you think people vote by logic or people vote by emotion? I think the answer is pretty clear, right? People vote, most people vote on their emotions, right? So in the same manner, in the stock market, right? In the short term, prices fluctuations, market cycles is really like they react more to emotions. They react more to news flow, the macroeconomics changes, development, market trends or sentiment, climatic events, unexpected events like, what happened yesterday night when Jay Powell took to the stage and said that he declared that, the Fed really needs to do more. They need to hike more. They need to deliver higher interest rates. They need to prolong the higher interest rates regime over time. So that had a knee-jerk, the market has a knee-jerk knee-jerk reaction to this event. I'm not sure whether it is unexpected or not. I kind of expected it, and I think the market reaction was not as bad as people feared. As well, in the short term, traders tend to influence more the price movements rather than the price discovery mechanism of intrinsic valuation. On the other hand, if we stretch our time horizon in a much longer period, the stock market, the pricing mechanism is really like a weighing machine, right? Where it is more determined by the value creation prospects of an asset, of a business. It really depends on the microeconomics, how the business improve their financials over time. It depends more. It is more dependent on the long-term market drivers or the market shifts, as well as economic cycles, and the price discovery, instead of, as I mentioned before, instead of more influenced by traders, it is actually more influenced by the intrinsic value accretion over time. All right. Now, don't worry if this sounds all gibberish to you. I will give you a couple of visual examples later on to help you strengthen on the concept of these differences. But all in all, I would like to stress that, a more intelligent approach, although there are two sides of the coin, right? A more intelligent approach to investing is really to have a long-term view of an investment thesis, all right, of the kind of businesses or sectors that you invest in, while being mindful of the short-term events. Now, I know a lot of value investors do kind of play down on the short-term events, but over here at Spiral Thinker, we have a different approach to this. We think that we should not always ignore short-term events, although in the bigger scheme of things, short-term events, we may not necessarily react to the short-term events where it may lead to high fluctuation in the price. But sometimes short-term events may really lead to a bigger structural shift over time. Case in point, back in 2020, who would have thought that a small outbreak of a virus would have led to a huge full-blown global pandemic, and which would then lead to a supply chain bottleneck, and then who would have thought that a supposedly transitory inflation will lead to a full-blown inflation crisis in the whole world as well. So sometimes it does pay to be mindful of the short-term events, especially those related to the economic cycles. And then we may not necessarily need to react to those short-term events, but we need to be mindful so that if it does metastasize into something which is more how to say destructive, then we've got to really relook at this short-term event and see how it may impact have a more forceful impact over the long term. So I hope that you guys understand this, and this is something that we really take care of, especially in the past couple of years when market is so volatile, right? Anything can happen these days. Right. So moving on, I would like to talk more about the margin of safety and its importance. I know a lot of value investors, they stress on margin of safety, but what is really margin of safety without going through the complex definitions or the formulas, right? As I mentioned before, complexity doesn't necessarily reflect an intelligent model. So I would like to in order to answer this question in a very simple manner, I would like to share a quote by Seth Klarman, who is a renowned value investor on the margin of safety. I think he has a very famous book on this. He said that margin of safety is simply the process of determining the underlying value, sorry about the mistake here, of a security, and then buying the security at a considerable discount from that value. It is really that simple. So what it means is, okay, margin of safety basically means you determine a value of an asset or security, all right? So there are many school of thoughts on how you derive that value. Then you pay much less for it, or you wait for the market to give you a very steep discount, or a discount that you deem is feasible for you to buy it, right? So it's really as simple as that. So that part is the cognitive intelligence, right? So this is where the scientific process will kick in and say, okay, how you determine the value, or you wait for, and then you just have to make sure that you buy it at a much steeper discount. Now, on the other hand, and to me, and this is more important, factor aspect of the margin of safety, the greater challenge is really to maintain the requisite patience, the required patience and discipline to buy only when prices are attractive and to sell when they are not, avoiding the short-term performance frenzy that engulfs most market participants, right? So this part is really talking about the emotional intelligence here. So the margin of safety has two parts, the cognitive intelligence and the emotional intelligence. Now, over time and over the years, in my experience, I find that it is much harder to tackle the emotional intelligence because as being a human, right, I can't, especially being a full-time investor, sometimes I just cannot distance myself from all the excitement in the stock market day in, day out, right? So I would like to visualize this using a simple chart. Me being an engineer, I like to visualize things, right? So imagine, I think typically this is how a stock price would go on the red line. Stock price will go up, they'll come down for whatever reason, then they bounce back up even higher and then come down again. So this is a very natural feature or a natural characteristic of the stock price. And remember, price is really a voting machine. Now, on the other hand, sometimes, most of the times, there is an underlying quantitative valuation of what the price should be. And you can derive this, you can get this from, a lot of especially after a company releases financial results, that's where analysts or fund managers or investors can update their scientific model of how the business should be valued, and that's where maybe you can use earnings per share. I tend to use more on the cash flows angle as well as the balance sheet. All right, then from there on you can estimate, okay, what should be the moving forward, what is the quantitative value of the business using all this scientific approach, right? But sometimes the situation may happen that the perceived value of a business may go up. Okay, for example, company X sign an MOU with a Taiwanese company to deliver so and so, or to build so and so, right? So the market will perceive, oh, because of this development, the future should be much better for this company. So the market will perceive the company to have a much higher value from this point moving forward. But more often than not, when a company or business is subject to such a high expectations and they fail to deliver, for example, in this case, the quantitative value is expected, the perceived quantitative value should be this high, but then the company did not deliver. In fact, it delivered for whatever reason, could be due to forex losses, it could be some issue with the supply chain, they did not deliver what is promised, then the market will react instantly, because in the short term, price is a voting machine, right? So you will see the share price do a somersault like this to the bottom. And then when it is being oversold, market is always very emotional. They say one day they wake up and realize, hey, actually, this is too low already, and the company should be worth so much more than this. That is when the support will come in, all right? The buying support will come in, and that is when it will drive the share price back to equilibrium. Now, of course, over time, if the company can withstand and overcome these short-term challenges, right, and eventually, they will deliver the results, right, the stock price will eventually go up again. And what is important here in the aspects of margin of safety, is these two regions. Simply said, the margin of safety is really buying a security or asset when it is below its value. All right, it could be, people say it's intrinsic value, but over here, I have not talked about intrinsic value yet. I'm just talking about perceived value or the quantitative valuation of a certain business or asset. And then to sell it or take profit when it is on the other end of the spectrum, which is in the euphoric zone. You remember he said that, Mr. Seth Klarman said that to buy only when prices are attractive, which is in this MOS value, I call it, the value of margin of safety, and sell when they are not, which means that the prices are not attractive to hold anymore. But don't forget that sometimes the market may really perceive the value to be much higher than what you think, what one particular investor thinks. So the market may continue to drive the price up. So that is why I think in many of my portfolio management sessions, I did mention that never ever sell everything in one go, and never ever buy everything in one go as well. You've got to stagger your purchases and your sales, right? So this is generally the concept of margin of safety from my point of view. All right, the corollary would be the intrinsic value of a security or a business or asset. The assumption is that it will grow over time. All right, and perceived value does not necessarily reflect the intrinsic value, because over here I have not talked about the intrinsic value yet. Don't bear in mind, quantitative value can be derived in a scientific manner. That is that is why we read analyst reports. That is why we read sector reports as well from all these investment banks, right? But it does not necessarily reflect the intrinsic value of a company. Now, to estimate the intrinsic value, we require more of the cognitive intelligence, whereas to manage the price valuations like this, it is really where the emotional intelligence play a more important role. So you ask me, hey, David, where is the intrinsic valuation here? Now, remember I said that intrinsic valuation, in my opinion, is not something that you derive scientifically, but it's more something that is inherent a business, which is assumed to grow over time. So intrinsic value is really the true value of a business over time, which is more reflective of a weighing machine. A weighing machine will tell you what is the true value of something. All right, when it comes to stock valuation, it will be the intrinsic value. It will be the value that the company delivers over time. Now, it may not necessarily be something that you derive from complex formulas. No, I don't think that is the way to look at intrinsic value, although Warren Buffett may have his methods. My understanding of intrinsic value is as long as a company delivers shareholder wealth creation over time, and that they are doing all the right, that they execute the right decisions, they are able to, carry out their plans for growth, right? This is where the company's intrinsic value will really grow over time without looking at the, without really dabbling on complex mathematical formulas or models. Right. So this is where people like us, a layman like you and me, who are not professional or licensed analysts or fund managers, right? We can still beat the market. Now, in the short term, of course, we will never beat, computer algorithms when it comes to managing the price fluctuations. The computer will always be faster than us. All right. But what we have, assuming that, you go through you persevere over time and you really strengthen your mental model and you become a wiser investor over time, right? And we have a more longer term view of our investment, right? This is where we can really beat a lot of algorithms or even these computer high frequency robots, right? Because robots, all these algorithms react more on the short-term fluctuations, whereby as long-term investors, we focus more on the long-term value of a business. Right. So to cap it, there are a few elements of margin of safety. It's not just about the price, because price are just instantaneous. They are more sentiment driven. We have to anchor price and compare it with the quantitative value of a business, which is derived through a more scientific approach, the cognitive, which really requires a cognitive intelligence, a certain level of cognitive intelligence, going through a systematic process. Then to top it off, right, we have to really look at the margin of safety from the angle of an intrinsic or a perceived value as well. Not just about, okay, this business should deliver earnings per share of so and so over time, and we give it a PE or how many multiples, then we come out with a quantitative valuation. That is only one way of doing it. There are also other ways of a perceived value, how you perceive the business to grow over time. And really what the business how it will really grow, how it will really create more shareholders value over time, right? Now, this is where we can really apply the different angles of margin of safety as well. Now, coming back to Benjamin Graham, he also stressed the importance of margin of safety in his book called The Intelligent Investor. He said that the function of the margin of safety, right, in essence, is really just to render unnecessary and accurate estimate of the future. Now, this is a very important quote in my opinion, because without margin of safety, then we will have to be really be accurate in our estimate or our projection of a particular business value or asset value. But by injecting a margin of safety in our thesis, in the way we execute our trades, right, then we give ourselves that margin, that buffer, that room for error, so that we do not really need to be accurate in our execution. And that is where over time this will increase our success in our investment journey. And it is also the more intelligent way approach to execute your to realize your investment thesis as well. Now, I know there are a lot of traders out there, technical analysts, enthusiasts, who really look for the specific or right laser sharp timing to enter or to exit. I think that can work as well, but in order to repeat that over and over again consistently over time, at least from my own personal point of view or my personal experience, it never happened to me lah. So that's why I feel that I really strongly believe and advocate that margin of safety is really important, an important element that you really have to factor in your investment decision. All right, so that's about the margin of safety as well as the fundamental difference between price and value. So moving on, I would like to take things to a higher notch by really looking at a case study, which happened to me personally in the past a couple of years, as well as something which happened more recently. And I call this the oxymoron of prediction. Now, when it comes to investing, right, it is inevitable that we will be doing some sort of forecast, whether it's predicting predicting the price movement or forecasting a net profit of a business. We are really taking a bet, all right, of what will happen in the future. But of course, to segregate ourselves from purely gambling or speculating, right? We have to approach this in a more educated manner. So naturally, in my point of view, in my experience, right, normally what we do is we make references to a lot of the past or the present figures or the elements of a business or a security, like what is the financial figures like, what are the cash flow, what is the utilization of the business, what is the working capital management, what is the operational efficiency, right, and what is the integrity of the management, what are the margins the kind of the business can make consistently and sustainably. This will give you a some sort like a confidence when you do a prediction for the future or the outlook for this business. Now, when it comes to predicting the future or forecasting the future of a particular business or a security, right? There are a lot of qualitative stuff that we look at. Now, in my opinion, one of the most important elements I look at, but when I try to forecast the future outlook of a particular business, is really the manager's visions and drive. The manager or the founder or the major shareholders of the business must have the drive to grow the business. If there is no drive, right, then the intention of the main shareholders or the insiders may not be aligned to us as a shareholder, as a minority shareholder. And if I find out to be the case, normally I'll just shy away. And there are many examples of the stocks in KLSE that behave like this, right? Now, apart from that, CAPEX is very important because CAPEX will, especially for manufacturing business, it will show you, it will give you an indication how the business will grow in the future. Especially for tech or semiconductor business companies, R&D plays a pivotal role, because without R&D, then you will not have a new product introduction, and without R&D, without NPI, right, there is the intellectual property of the business will not strengthen. All right, then if a company does not have a strong moat, economic moat, then they will always be subject to competition, and so on and so forth, right? But of course, other macro factors like economic cycles, the macro events, market trends will also play an important role when addressing, we're trying to forecast the future of a company. So these are just some of the key considerations for you when you want to try to forecast how the business will perform or how a particular sector will grow over time, right? But that is not the main takeaway that I want to deliver here. This is just for a reference, as a prelude to what I'm going to share in my case study, right? So I think one of the most profound experience that I got back in 2020, is that, I thought that one company that invested in them should surely make money. All right. And I'm not sure how many of you out there experienced this very funny situation whereby the company really announced a very strong quarter on quarter, there's growth, so on and so forth. And then year on year, there's really good prospects. But why did the share price keep coming down instead of going up? Case in point here, back in 2020, during the pandemic, I was thinking, hey, everyone was staying at home. Nobody is going out. All right. So everyone was playing the stock market. Everyone was making money from growth stocks. All right. So I thought naturally, then the Bursa, being the being the monopoly of the stock market in Malaysia, they should really make money. It's no-brainer, right? So rightfully so, when they announced their third quarter results on the 27th of October, their revenues grew 1/3 quarter on quarter. Their net profits grew almost 50%. The cash flow doubled up 2x in the span of 1 quarter. So I was so happy, and I remember that they announced the quarter results in the noon break. So I thought, when the market opens, right, because I just bought the Bursa. I mean, I added quite a lot of Bursa stocks before this announcements. I thought, I was predicting the business to deliver a very strong quarter result. That's why I added my position. But lo and behold, look what happened. Look what happened, right? The quarter result was announced around here, and look what happened to that. Instead of going up, the price kept on coming down. Then, of course, after this, there was also the market impact. The market sentiment was really bad. Back in 2020, every day was like a new experience for all of us. I'm not sure if you remember those days. Seems like ages ago, but to me, it feels just like yesterday, because those were the time I felt that every day I went through different psychology effect. Every day there's this term we call 改变性, and every day I change my religion in the stock market, right? So that was what happened. And then I realized one thing, actually what happened was the market had a much higher expectation of what the Bursa Malaysia's result should be then. So the market was expecting a higher perceived value over here, something like this. And to be fair, the Bursa stock price has advanced from, I think, of a low of 4 ringgit back at the throw back in March 2020. That was when everything will crash, right? To as high as 9 ringgit over here. All right, at the recent peak before the announcement of the third quarter result. So the market was really pricing in a much higher expectation of the results. So when there's a market, I'm referring to the market participants like the analysts, the fund managers, or maybe insiders. They were expecting a much higher, better results than this. So, and when it didn't happen, so to the layman who do not have access to all this information, I thought, hey, this was a good result, quarter on quarter, it grew many times, here. But then because the result disappointed a lot of these expectations, that is when it started to slide. But of course, again, like I mentioned, the market sentiment did play a role over here as well. So this is just one oxymoron that one very funny experience that I had that made me realize, actually, sometimes you really cannot know what the insiders or the other market participations are expecting to happen. So I realized from this experience, I do realize one of my most important lessons is never try to predict a stock price movement when it comes to quarter results, right? Because you may be right once, you may be right twice, but to do it consistently, to be right consistently like this, it really, unless you are a market syndicate or you are a market insider, I don't think it will be a very successful enterprise for most of us, including myself, right? And don't forget that, in the short term, right, market sentiment does play a role as well. And that is really what happened, what caused market fluctuations. The price fluctuation is really the market is trying to price in the expectations. For example, for the most part of the past 6 months since last October, market has been pricing in higher interest rate regime, especially in the US, right? So the Fed has been doing a good job guiding, what is the expectation of what to expect in the future. They say, okay, we expect the Fed fund target to be between, say, 5 to, I think the latest figure was 5 to 5.25%. When that kind of statement goes out in the public, right, the market will react straight away. And that's why, this greed and factor index, which is being popularized by a lot of these news media like CNN, CNBC, right? They become a very popular gauge. It's really, and what is really funny about it is you can see the index for different periods of time, like the previous close 1 week ago, 1 month ago, 1 year ago, can fluctuate a lot. And that is what gives rise to the price fluctuation of the market here like this. And again, this is really just to strengthen, that in the short-term market, it's really like a voting machine. And as long as you are a participant in the market, right, whether you're a long-term investor or you're a short-term investor, you have, it is inevitable that our portfolio will be affected by, these kind of things, right? So just bear in mind, just as long as we have a long-term view, by right, these should not impact us too much, especially on how we execute our plan, Right. So coming back to my case study, this is something that happened to me personally as well as my team. More recent events, right? And this talk called MI Technovation. Now I've talked about MI in many of my other sessions related to semiconductor and technology last year. So I think it will be useful for the listeners out there and the viewers out there for you to refer back to those sessions if you had not. Otherwise, you won't understand why we started investing in MI, right? So MI was a peer review gone wrong, and it's something that it is a generalization of our mental model that led to a wrong prediction of what the quarter result would be. I said that, I by right I should have learned from this experience, right? But as I mentioned before, my personality is that I will need to go through a series of mistakes before I really hammer in what is the right thing, what is the right method to approach a certain thing, right? So when it comes to MI, this is just a trade record for one of my portfolios. So we started buying. Actually, we started really looking seriously at MI since I think in the third quarter of last year. We've been accumulating, we've been trading this stock for quite a bit from August last year to recently, right? So what happened was in recent months, in the past, in February, before the release of the, I think, Q4 results, based on our channel checks, we found that actually a lot of the semiconductor players, especially those with exposure to China, were suffering very low utilization rates because of the China lockdown, right? Or say, GG already we say, especially companies like MI, so MI really strengthened our, our thesis. MI reported a really underwhelming Q2 financial year 2023 results before this is MPI, not MI. So MPI reported a very underwhelming result. So it caused the share price to tank due to the weakness in China. So we thought, MI has exposure to China as well, especially in the new business unit, which is related to the materials. So we said, and some more they were banking in on the growth of China. We were all banking in for the China reopening for a lot of these semiconductor companies. And on top of that, to top things off, to make things worse, to make our fears more real, at this point of time, during our last purchase of MI back in 7th of February, we had as much as 11% of our weightage of a portfolio on one stock, on this stock MI, right? So to you, maybe 11% is not a big deal, but for us, we do, because we focus a lot on allocation. So unless we are really, really sure and, we are sure convicted with our thesis, right? Normally we would not go more than 10 or even 12, 15%. So in this case, coupled with all these bad news, right? We were quite, to be frank, I was quite worried about this holding, right? So after a few rounds of, sparring of ideas with my team, we took the educated decision to slash our MI weight by half, from 11% to less than 5%, So we, of course, as I mentioned, we do not usually sell everything at one go. So we stagger our sell as well, depending on the market situation. So we thought that, I managed to sell at 160 or as near as 160 as possible. I thought I was smart. But lo and behold, what happened on the 22nd of February? MI released the result. Bang! Everything was so rosy, Sequential higher equipment sales to China instead of lower sales. I was scratching my head and said, oh my God, what happened, So, and to make it worse, the share price advanced 24% in a day after the release of the quarterly result. So whatever we generalize from observing the other semicon players which has exposed to China did not happen to MI, because again, MI, they cater to a very niche market. They have a much different business strategy when it comes to China. So kudos to them, they did really well, and I had to really admit my mistake here. So my only consolation is, instead, we still have at least 4.7, 4.8% of our portfolio MI, which because of this jump in price, which it pushed up the weightage to about 6-7% in a day, So now the more important thing is, yes, this is a lesson learned, but moving forward, what would a typical intelligent investor evaluate the outlook for MI? So this is more important lesson to learn here, and I hope you can just follow me here for a bit before I end the session, right? Back in 2021, I think back in 2020, MI announced the intention to acquire this business, this Taiwanese business that makes soda balls called Accurus, that will form their new business unit called SMBU, Semiconductor Materials Unit. Now, previously, before this, MI was entirely focusing on equipment business, right? The automation as well as the test handlers, so on and so forth. So this made 100% of their revenue in 2020. Now, in a span of less than 2 years, slightly more than 1 year, this SMBU business unit grew from nothing to 53% of their revenue by the end of 2022. Now, I don't know about you, but to me, for a business to be able to grow something new, to overtake, half of the top line in 2 years' time, is a fantastic, it's a fantastic, achievement, right? So, to me, this is something that I think it will continue to grow. I'll explain my reasons for this later. And to top things off, I think the management is very smart. They say that this is part of the 10-year plan, right? They're going to create a new business unit. They're going to expand the business by creating a semiconductor solutions business unit to focus on other than final products of renewable energy and electric vehicle segments. Very smart. That will include, production of power semiconductor materials as well as fabless manufacturing processes. Now, I think the management is very smart. They are doing all the right moves to create more value for the business in the future, right? So I just recreated this from my mental memory after attending the Q4 analyst briefing just a couple of weeks ago. Now, I think in a nutshell, what I want to show you this is MI, the founding management has a 10-year roadmap for every 10 years they will have a new roadmap, right? So the current roadmap is started back in 2019. Which will last into 2028. So according to the management, they say that for the first half of this 10-year roadmap, their focus will really be in expanding the market share. So, which means that they were really focusing laser sharp on growing the top line of the business, which they did. They did by creating by expanding the market operations by creating new business unit. Then for the second half of the 10-year roadmap, their focus will be on expanding the margin of the business, which means to grow the profitability of the business. Now, of course, without going through the details tonight, he did mention how they will do it from in the Accurus business or the SMBU by introducing new products with higher margins, so on and so forth, as well as creating a new business unit called SSBU, right? So I thought that the management has proven themselves in the first half of the 10-year roadmap. So I don't know, as from my personal point of view as a shareholder of MI, I'm kind of excited and I kind of have faith in the management that they will be able to deliver this promise in the next 5 years to come. But of course, past performance does not necessarily reflect future performance, right? So I would really follow through their plans, and so that's why reading quarterly reports and annual reports, attending AGMs is very crucial, so that you follow through what is the progress of their plans. For sure they will encounter a lot of challenges. There'll be a lot of hiccups. They may be, and I shouldn't say maybe, I expect that there'll be changes in some of the plans. For example, the SSBU may be focusing on something rather than this. But so far at the moment, for what I can see, they're ticking all the right boxes, in my opinion. So, again, in a larger scheme of things, right? will the market price in MI's growth expectations eventually in the future? Really, that is depending on how you understand the business, how you know the management, and whether you have faith and conviction in the business, in the management, that they will continue to create more shareholders value for us in the future, right? So the question begs that, does MI's recent developments suggest intrinsic value accumulation or accretion in the making? So your guess is as good as mine. Now, by drawing this arrow here, doesn't necessarily mean that the intrinsic value will grow like this. It could grow or exponential, or it could be flat, we don't know. But as long as the management deliver their promise, that they execute their plans properly, and the market is in their favor, especially with the reopening of China, I think it should do well. This company should do well in the future. All right, all things equal. So coming back, I think that is the end of my sharing tonight. So just to conclude, having the right intelligent mindset is absolutely crucial in order to secure a sustainable and successful long-term investment journey. So we have to understand what makes an intelligent mindset, what are the things that we need to do from a scientific point of view, as well as the empirical approach, to really strengthen our cognitive model, as well as strengthen our emotional intelligence when it comes to managing the price fluctuation of the stock market, right? So I talk about the oxymoron of the prediction. Now, by sharing with you the mistakes that I've done throughout in the past couple of years, and most importantly, why we decided to deliver this topic tonight is really just a prelude to what is bigger, which is coming, right? First, you need to understand what is required to have an intelligent investor's mindset, which is important in Benjamin Graham's words. The most intelligent way of investing approach is really to do it as business-like as possible, right? So the reason why I talk about this topic tonight is really a prelude. You have to understand this first, then only you can come up with your own mental model. Now, mental model is something that Charlie Munger really stressed a lot. He said that you've got to have mental models in your head across different experience, whether it's good or bad. And he has his own lattice work of mental models, which he really say is the foundation of his success in investing for so many decades, right? Now, at Spiral Thinker, and my team and my group, we do have our own mental model. We call it the spiral thinking model. And which is and the building block is actually really having to have an intelligent mindset, that only we can have built our own mental models when it comes to investing. So I will be talking more about our spiral thinking mental model, I think towards the end of this year. I think my session is scheduled on the November. So if you have found this session to be useful, I hope that you can join me in the coming session in November, where I really put all this applied intelligence into, how we apply this applied intelligence into our different spiral thinker mental models when we approach investing, as well as how we live our life. Yeah. So I hope you enjoyed this tonight. Shane, back to you. Any questions or not?
Thank you so much, David, for being very open and frank with us with your recent case studies. I think many of us here today would have a very enlightening sessions, learning how do we improve and manage cognitive intelligence and also emotional intelligence. All right. So if any question for David, please write them in the Q&A box so we can address your questions. Write them in the Q&A box. Don't write them in the chat box. Okay. So if you write them in chat box, I could have miss your question. All right. So write a question in the Q&A box.
Actually, there's a question by
Philip.
Sam. You want to tackle that?
Oh, sure. We can.
Can we truly rely
Can we truly rely on analysts write up on a company share? Would it be accurate?
Okay, I give you my really frank answer, Sam. I do rely on analyst report. All right. So when you say a company share, I think you are referring to the business, right? So there are a lot of information that I will not be able to have access to other than reading analyst report, because most of the time, because analysts represent certain big investment bank, right? They have the ability to open doors into the management of a listed company. People like us, spiral thinker, who are you? What is how much money are you investing, right? So normally they look at that. But for analysts and fund managers, they normally open. So I do read the reports, but I read the reports not to look at what is a price target or the target price, so to speak. I look for elements in the reports that will help me strengthen my model of the business or my expectation of a business. For example, give you a very good example. A lot of times the report, especially when it comes to reporting on manufacturing companies, they will tell you what is the utilization rate. They'll find out what is the capacity that they have. They'll sometimes even tell you what are the customers that they serve. So these are very important information to me that I may not find elsewhere. So that's why I still value a lot of, I still value analyst report. I'm very thankful for all the hardworking analysts out there. I remember when I was in MI session before the session start, right? So we were talking among Mr. Orr, the founder, as well as some of the analysts. I overheard some of them say, oh, this is earnings season. I have 4 or 5 reports to write in a night. 4 or 5 reports to write, in a day, I was thinking to myself, oh, thank God I'm not an analyst. It's because I'm just reading the reports. I'm very thankful for them. So coming back to your questions, you have to pick what information to digest. Don't just take everything blindly. Always verify, because the analyst could have a different angle, or they could miss out certain things. So I hope I answered your question on Sam's question.
I think David also agree with you that when we read analyst report, it can help us to gain more knowledge and insights about a certain industry, about a company, about what is happening to that industry and to that company. But we just don't rely on the target price too much. Just take it as a reference. Okay?
Take it with a pinch of salt, I would say.
Yeah, because the analysts can have a lot of channel checks that we may not have these kind of resources or the channels to.
Well, in a way, it's kind of unfair, right? But anyway, that's a topic for another day.
Yeah. So grow your wealth, then you'll be fair.
Yeah.
All right. So the next question is, can we rely on software to find out what is the value of the stocks? A different software will give you different values since it's very subjective, right? So this question is by Philip.
Yeah. Question is from?
Philip Kong.
Philip, yeah, thanks for that. I think it's a great question. I used to rely a lot on this quantitative, I guess, valuation. And there are so many school of thoughts, I think there are so many ratios and so many ways of deriving the intrinsic value or the target price of a stock. If you subscribe to all these databases like Guru Focus or Ticker or some of the local database providers like Equities Tracker, they will have their own quantitative approach. That may not necessarily jive with how I value the company, because as you know, our approach at Spiral Thinker is more of a qualitative angle. But I do look at their way of how to derive that value, and I look at as not the final figure, but more so how they come to that valuation. Now, some database they will have a lot of definition or a lot of explanation how they derive it, but some of them is just pure lock, stock, barrel. Just applying certain numbers or parameters into the formulas, and boom, voila, they'll give you some sort of arbitrary number. I do not necessarily subscribe to that, and I don't usually refer to those. I do take it as a reference, but I rely more on our own valuation metric for that particular company. I mean, for especially for investors who are not used to this, you can take it as a reference, but I always encourage everyone to do your own. Now, just to share with you, when I started out, right, when I had absolutely zero knowledge about stock valuation, my first approach, like almost everyone else, is to do PE analysis, right? That's what I did. Then at first it worked. It kind of worked, when market is bull, everything works, right? Then I realized, hey, actually this PE analysis is not necessarily accurate, or it may not apply to all cases. And that is when that realization triggered me to look for other ways. And then over the years, that is where I shifted from quantitative analysis way of doing things to the more qualitative approach, because I feel that that is more reflective of trying to find out what's the intrinsic value of a business over time. Philip, I hope you answered the question. Short question being answered like this.
Yep, I think the intrinsic value calculation that was produced by the different software just serve as a reference.
That's
See, so if you
present, really, please take
yeah.
it with a pinch of salt. Unless you really find out, you ask the database provider how you derive that, but I doubt they will answer you.
Yeah, that's right. So the next question is by David. What sort of analytical tools that we should equip to be an intelligent investor?
Oh, I thought I shared with you already. So maybe let me come back to this slide. Okay. So there are there are different tools for different aspects of the training. I'll call this a training process. All right. So when it comes to the scientific approach, the tools that I use is really reading a lot of these reports. And I particularly value industrial reports because that will give me a bird's eye view of what's happening in the market trends, right? For example, many years ago, we actually started to look at sensors when everyone else was still talking about the timing devices, and that is when we found Getronic, and then that is also where we found a lot of good companies like Pentamasters, so on and so forth. Then after that, then we realized actually when the sensors, when we read more into the sector development, right, we realized the market for sensors are being is getting congested, which means the competition is coming in, margins are coming down, and a lot of good companies are moving on to lighting, so on and so forth. Then you can get the gist. So when it comes to the studies, reading a lot of reports, I think is something that we cannot run away from. Then on the other side of the equation, I do rely on different tools like Good to Date to try to refine my trades. Because for me, I don't just have one portfolio. I have multiple portfolios that I do write my own scripts. I do write my own Excel VBA to help me do allocation, and that's where I learn, what is the best way to approach certain campaigns, certain trading campaigns, and over time I will come back to my model again, try to refine. So I'm not sure if I answered your question, because your experience could be very different than mine. If you are just managing your own portfolio, like one or two portfolios, right, I think your process should be much simpler than mine. So I'm not sure what you meant by tools, other than reading a lot of reports. I don't think I have any other tools that I can offer you tonight.
All right, thank you so much, David. The next question is by Haslina.
Yes,
there were rumors saying that some bosses will pay analysts to write good things about the company so that more people will buy the company shares. So what is your view on this?
Well, well, you really put me in the spot, Haslina. Okay, from what I heard, and this may not be necessarily true, but from what I heard, this does happen, but not all companies are like that. I think some dodgy companies may engage in these kind of activities. So I personally do not dabble into this kind of stocks. I think that to me, this is a zero sum. That is a zero sum game. As a long-term investor, I look for a positive sum game whereby value is created on the long term for everyone, not just the short-term guys, but also for the long-term investors. As I mentioned here, sorry about that. Where's my slide? I'm looking for my slide. Yeah, something like this. So I look for companies that will create shareholder values in time. So to answer your question honestly, I mean, just think about it logically. The stock market is so vibrant, right? There are so many market participants. There are long-term investors, there are short-term investors, there are speculators, there are gamblers. There are syndicates, because without them, stock market will be very boring. So when you have so many characters, different characters swimming in the same pool of water, I think you have characters like that. So I wouldn't discount that possibility. So I hope you get my point, Castina, without putting myself in the hot soup.
All right. Now,
Yeah.
Keith would like to ask you about, is there any guidelines to decide how to determine the margin of safety of a stock?
Yeah, good question. I thought I had already, given the thought process here. So, I would say, not. I wouldn't answer on the guideline, because it could be a very subjective enterprise. To me, if you say, okay, I want to look for a margin of safety, is 10% enough? Is 20% enough? Or you need to go more than 30%? So this is a very personal choice. Now, in my opinion, it is a moving target. So as long as, first of all, you must have the concept right. So the price must be anchored to, there are different approaches to it. So if you are go for the quantitative angle, so look at the quantitative angle, right? Then from there, you look at things like, okay, for example, now our target is not to try, if you follow my mouse here, Keith, right? Our target is not to buy it here, because I can tell you it will never happen. If it happened once or twice, congratulations, but it will never happen to us consistently. So our best approach would be to buy or to add on to our position along the way like this. All right. Now, as long as you are investing in a good business that has a value creation over time, right? There will come a point in time or a price level where it will just become too cheap. Then the market will price in the mean, first of all, mean to revision, then only to reflect the future growth like this. So a guideline, I would say to use these different factors, but if you ask me about a guideline of how many percent is a good margin of safety, to me, there isn't an absolute value, but something that you just have to appreciate, as well as gain some sort of experience over time. Now, different stock may behave differently as well. For example, I wouldn't expect this kind of price fluctuation for a stock like Nestle. You can do something like something like a true value range. Sorry, the price volatility over, say, 3 months, 6 months, 12 months, to see what is the maximum volatility or the maximum drawdown or the maximum uprise for a stock in that band. Then you can decide from there. So okay, now the price is near the lower band, so it should give me a good margin of safety considering the historical price movement. So this is the kind of exercise that we do as well when we look at different stocks. Yeah. So again, I'm very sorry there is no definite answer, but really this is how we approach this subjectively. Keith, right? Shane?
Yep. All right, let's do one last question by Edmund. Now, most of the times, good stocks are overvalued.
Yeah.
So how do you get the first-hand information of any undervalued stocks?
Wow. Again, this is a very subjective question. I do have the answer, but I don't have one set of answers. Maybe I can quote another case study for you, which happened to us recently as well. Is that fine, Shane?
Sure.
Right. We are a little bit over time, but I think it's okay. Now, I think back in the 2021, when everyone is still feeling the pandemic pain, right? When the planes are still grounded on the tarmac. You remember those days? Now, naturally people will tend to shy away from aviation stocks, including the companies that supply to aviation, like the SAM Engineering, all the companies that supply to these aeroplane makers, right? So one of them is this SAM Engineering, and a lot of people perceive SAM Engineering to be they focus too much on their aviation business. Rightly so, because I think the management did guide a very bright future, and when they embark on the aviation journey, they say that their aspiration is to hit 1 billion revenue for aviation. But because of that, a lot of people forgot about the other part of the business, which is the equipment. And we know that during the pandemic, the demand for electronic devices, consumer devices skyrocketed. And SAM having that part of the business, and that part of business grew very well, right? So in that, right, actually it is our consistent follow up of the company that led us to remember, hey, actually this SAM Engineering, right, their equipment business potentially can overtake the aviation business during the pandemic era. And that was what happened, and that was what caused the share price to advance from 8 ringgit to 20 ringgit in less than 6 months. I remember those days. So you have to have a follow through of the business that you invest in over time. Now, sometimes when the business inevitably go through a down cycle, you may want to reduce your exposure, like what I did with MI, right? But it doesn't mean that you should just give up. You necessarily have to give up on the business entirely. For us, we usually keep those good businesses KIV, keep them in view. Then when the situation turn back in favor to them, then we will look back at our notes and our understanding of the business, and then we will see whether there is any potential for a re-rating of the valuation by the market in the near term. So that was one of our success stories back in 2021 when we spotted SAM Engineering before everyone else was looking at this company back then. So I hope I answered the question by giving this very short case study.
Yeah, thanks for sharing with us this practical tip on how do we spot undervalued stocks beforehand.
Yeah.
All right, so
I think remember to tune in November when we talk about the spiral thinking model.
Yeah, that will happen in November.
Yeah, very long from
here. All right, so that shall conclude our session with you today, David. So thank you so much for sharing with us, the strategies to develop an intelligent investor mindset. Thank you so much, David. All right, so before we talk about next webinar, let's talk about Bursa Academy. So I think this is the comprehensive one-stop e-learning platform that aims to provide you with a continuous and holistic learning journey. So you can scan the QR code to go to the website, and you find a lot of investing resources there. So for our next webinar, it is titled Passive Investing with Sharia Compliance ETF Exchange Traded Funds. So we'll do this on the 10th of March, which is this Friday. It's from 8:30 to 10 o'clock. So you want to join us in this session to learn about how do you use ETF to create passive income streams. So this is the sessions that you should attend. So with that, I want to thank all of you here for tuning in until the end of this webinar. I hope all of you here have gained enormous value from David's sharing. So hope to see you in our next webinar. Bye, everybody. Thanks, David.
Thank you very much. Good night.